Good morning, everyone. I'm Deborah Feldman, Managing Director and Wealth Manager of the Leonetti team out of Chicago. Actually, we're not in Chicago exactly. We're in Buffalo Grove, Illinois. It's a suburb about 35 miles northwest of Chicago. But since few people outside of Illinois have name recognition with the town Buffalo Grove, you'll hear us refer to our location as Chicago from time to time. We're really excited to welcome you to the second Investment Town Hall of 2021. Today's program marks a significant event in the Fairport Luma Leonetti history. As you know, Fairport and Leonetti teams merged together about a year and a half ago in a desire to deepen our collective knowledge to help serve you, our clients, better. The webinar today is really special because it's the first gathering where our Cleveland clients and our Buffalo Grove clients will all be in attendance. So a very special welcome to everyone. Based on your feedback, we've scheduled these webinars on a quarterly basis, and going forward, Emily Drake and I will take turns moderating. The primary goal of these town halls is to connect you directly with our Chief Investment Officer, John Silvas. He'll recap where we've been, describe where we are today, and share his thoughts on what lies ahead. We asked for your questions in advance, and John and his team have prepared slides to address them and other frequently asked questions. While your advisors are in continuous contact with the investment team, there are some ways that you can be too. First, you can expect to receive by email the Fairport Perspectives. Second, you can subscribe to the Fairport Flash podcast on Apple Podcasts, Stitcher, or Google Play. Third, you can follow the hashtag Investing with Fairport on LinkedIn for weekly thoughts on the market and economy. A bit about housekeeping now. Everyone will be muted for this webinar and your cameras are disabled. If you have any questions that arise, you can type them into the questions section of your toolbar and we'll answer as many as we can, time permitting. So with that, I'm going to turn the microphone over to John Silvas, our Chief Investment Officer.
Thanks, Deb. So first off, I'd like to give a little shout out to my colleague, Deb. For you that don't know it, Deb was recently named to the Forbes 2021 list of top women wealth advisors. And for what that is, it's an annual ranking of the top 1,000 female financial advisors in the United States. So congratulations to you, Deb, on behalf of everybody at Fairport, Leonetti, and Luma.
Thanks, John.
You're welcome. So let's just jump right into it. Let's see if we can get the slide to move here. If I can. Maybe I can't. All right, first technical difficulties of the day. Slides are not moving. Give me 1 second here.
I'm going to blame it on that update that happened last night.
Yeah, it could be. Could be. There we go. I got it now. I lost a little marker, but I guess we're going to have to do without the pointer. I tried to get fancy, but anyway, there goes technology for you. So I thought we'd talk about the first quarter. You know, it's been a strange year. We did our first town hall, I think, in April of last year. So right off the bottom, the markets bottomed in March. We had the shutdown, and we did one of these in April. So kind of we've gone a long way over the last year. So it's been a crazy year, but you know, just to kind of put it in perspective, a year ago we were talking about toilet paper as the shortage. 1 year later, now in this April, we're talking about ketchup. So this is literally a front page article in the Wall Street Journal a few days ago that the new shortage is ketchup can't catch up. I think that kind of fits in our theme today, because the theme I think we want to talk about today is, you know, going from recovery to reopening. And, you know, shortage of toilet paper, unfortunately, is more of a recovery story. Shortage of ketchup is more of the reopening story. And I think as everybody's going out and about, getting takeout, going out to restaurants, this kind of fits into the whole thing. So we're going to talk a little bit about that. It's going to be a little bit back to the future. We're going to go to the past, to the present, to the future a few times over the next couple of minutes here. So first and foremost, you know, equity markets continue to build off the gains that we've seen in the second quarter. I mean, off the gains from last year, and as we head into what we think is the second year of a bull market. As you can see on this third column from the right, which is your year-to-date returns, small caps continue to lead. They were leading off the bottom in last March, and they continue to lead in 2021. So far, they are up about through the end of the first quarter, which would have been March 31st, up about almost 13%. Interestingly, REITs have bounced back off being one of the worst performers last year, up 8%, and then large caps, which is the S&P 500, is up about 6.2%. But we've had a pretty good April so far. So to build off the gains from the quarter end, just to kind of give you an update, the S&P so far through yesterday is up 10%, a little over 10%. The Russell 2000, which is that small cap indicator that I just mentioned, is up 13%. And the ACWI, which is the All Country World Index, which is more of a global equity index that we use as a benchmark, is up 8.5% so far through yesterday. Bonds continue to struggle. They're down so far year to date through yesterday 2.7%. As you can see on the slide, they finished the quarter down 3.4%, so they bounced a little bit off the bottom. But again, I think that's just a function of direction of interest rates, and we'll talk a little bit about where we think they're going to be going here in the next few minutes. So history would suggest we're going to see further gains going forward. If you look at the 10 best 12-month rallies over the last 75 years, the one that ended on March 23rd of 2021, which started a year ago, as you can see here, was up almost 75%. I'm going to round that up to 75%. It was the best rally we've seen, going back 75 years. If you look at the other 10 best rallies, history would tell you that they tend to be the 1-year return or 250 trading days from there tend to be positive on average about 12%. 9 out of 10 times it's been positive. So we think there's an opportunity to build off those gains that we've seen, and we'll talk a little bit more about that. So I'm going to pause there. We'll go into the economy and talk about some of the things we see in the economic environment. But any questions we have yet, Deb, or any questions you may have?
I want to circle back to small cap stocks, where you mentioned they're outperforming. Do you plan on increasing the allocation to small cap stocks in the portfolios?
So that's a good question. I actually have a slide later on in the deck that I'll show you, but small caps definitely show leadership off of what they call economic and market bottoms. So I would argue the market bottom we saw in March 23rd of last year, and again, we've recently anniversaried that over the last few weeks, was small caps perform just like you would expect them to. You would expect them to be leadership off the bottom. They tend to do that in past recessions and or beginning of bull markets. But as you get into these bull markets, the second year that tends to wane. So I think at this point, while we still think small caps are a value part of a portfolio, I don't know if we'd be adding to them at this point. We've actually took an opportunity earlier in the year to trim some of our mid cap and small cap exposure just because they had such a great run off the bottom. Something we're keeping an eye on, but I think, again, if history plays out like it has in the past, they'll continue to do well, but probably not show continued leadership going forward. So it's something we're keeping a close eye on.
Good.
Anything else, or should we move forward here?
We can go forward.
All right, great. So the economy, again, I'll start from last year. We were talking about, what shape the economy is going to be. We'll get into that in a second, but so far, first quarter is over. We're a couple of weeks into the second quarter, but we haven't got first quarter GDP numbers yet. But it's our expectations that the first quarter is going to continue to come in above trend, and we'll call trend at 2.5%. And I think that's a pretty low bar at this point. The Atlanta Fed does a really good job with their econometric model. It takes several different inputs into their forecasting model. Has been predicting about 6% GDP growth in the first quarter. And most economists out there have actually been raising their estimates. So 6% might be on the low end. I've seen anywhere from 5 to 10%. It's a little early now, but I think right at the end of the month, we'll find out where we fall. But either way, we're going to see well above trend growth over the next few quarters. The unemployment picture continues to improve. We had a big shock to the system last year where we had, I think, 16 million people unemployed at one point. But unemployment rate dropped from 16% down to 6%. I expect that to drop further. As you can see here, this is just continuing claims. We had the big spike up early. That's the shutdown of the economy, and we've been coming down ever since, and it's starting to wane here a little bit. but we're still continuing to see a pickup in employment. So we think that's going to continue. The most recent job number, which was for the month of March, we created 916,000 jobs, almost 1 million jobs. And I think we're going to see strong numbers like that over the next few months as well. So definitely a strong backdrop moving forward. Just to kind of talk a little bit more about expectations going forward, as I mentioned, a lot of economists right now are raising forecasts for where they think both the first quarter, which just ended, and then bigger picture, all of 2021. This is from Evercore ISI, which is one of the better macro research shops out there. And if I can get my cursor, there it is. They actually raised their GDP estimate for the full year 2021 to 9%. And just another interesting thing is they raised their earnings for next year to $220 per share for the S&P. That's on an aggregate basis, and that's been one of the things we've been talking about a lot over the last 12 months, getting back to what we think is normalized earnings, which will be 2022. And that's, I think, going to be key to where markets go going forward. And we'll talk a little bit about that when we get into valuations. Continue the discussion about Evercore ISI. They do a company survey, and we use this quite a bit for us just to kind of gauge real-time economic sentiment out there. And their surveys are now back above what we call pre-pandemic levels. So it's actually the best it's been, I think, since the last 20 years. Again, we talked a little bit about last April. Would it be a V shape? Would it be a W? I think there was a Nike swoosh. I'm going to get some of these wrong. A J shape, a square root shape. What was the shape of the recovery going to look like? And the V-shaped recovery, which is this very sharp drop and a very quick recovery, was probably the one that people thought the least likely. And it actually has turned out to be I think it's a foregone conclusion that we're in a V-shaped recovery. And I can show you a dozen slides and they all look the same. So that's great, and I think that's a strong indication for markets going forward as well. Just another one of those ones to look at is home builders. I have a neighbor 5 doors down, put his house up for sale on a Saturday, sold it on a Sunday, and got 5% above asking price. So home builders, new homes, and existing home sales are on fire, and I think a lot of that's due with low interest rates and the fact that people just want to move out to the suburbs. And why that's important is because home building is a pretty big input into economic growth. And when you see that area of the economy doing very strong, that's a good indication overall for the economy. So we do keep a pretty close eye on that. The other thing that we keep a close eye on as it relates to markets really is the credit markets. And there's an old saying that credit is the grease that kind of helps the economy move forward. And right now the spreads are very low, and that's this bottom chart. And that the spreads is the difference between double B credit and triple B credit rates. And the tighter that spread is, the better indication that the economy is doing well. And if the economy is doing well, markets tend to do pretty well. So the credit spreads tend to be the canary in the coal mine, so to speak, for markets. If credit spreads get widened, that's usually a sign that the economy is going to slow, or credit's coming to a slowing, which is always a bad sign. So we keep a pretty close eye on that. And so far, it's not indicating anything that I would consider a concern. I think we are going to see, though, as we go forward, so this is kind of looking ahead again, is there's going to be a lot more emphasis on the Fed. There's already been some talk over the last few weeks. The Federal Reserve has met a few times. They've done their annual Q&A in front of Congress. And we expect to see, a lot more attention on inflation and how the Fed approaches that. So far, they've been pretty adamant about keeping rates low, at least not raising the federal funds rate at all this year, and most likely next year. That could change. We just got CPI numbers, I think it was yesterday, if I'm not mistaken, or the day before. The headline number was 2.6, which is pretty high relative to the last 10 years. And then the core number is 1.6. But I think the Fed will remain on hold. They've already said that they're willing to let the economy run a little hot if they have to. I think they're more worried about full employment than they are about price increases or inflation. So we're going to keep a close eye on that, but I don't think there'll be any hikes at all this year for sure, and most likely not any Fed fund hikes next year. But that I think is probably a little less clear. I think as we see better numbers, and if they come in hotter than we expect, we could see that change. But overall, the economic recovery is definitely global. IMF here for the year 2021 expects 6% GDP growth globally, which is the highest we've seen since they started putting out their forecast. So again, I think overall speaking, the economy is on very good ground. I think it's moving forward. It's probably going to pick up as we go forward. So we're leaving what I would call the recovery phase and entering what is most likely the reopening phase, and vaccines and all those other things play a part of that. But I definitely think we're making a transition here as we go forward. So I'll pause there. Again, we can stop if there's any questions. If not, we can jump right into the markets.
Can we talk about a little bit about inflation? If we believe it's going to increase, will this mean to the client portfolios?
Well, so I'm going to go back. So that's a great question, and I think we talk about inflation a lot, and it's been a big headline topic over the last few weeks, and I think it will continue to be, especially as we see more deficit spending and all those things. So I went back to this one slide just to kind of put it in perspective. Long term, the last 50 years, headline CPI was 3.8%. Now, going back to the financial crisis in 2008, when we first went to zero Fed funds rate and really pushed rates down and started doing quantitative easing and all those other things, inflation for the most part has been under 2% most of that time. So over the last 12 years, give or take. So I think when we talk about inflation going up, I think 2.5% or 3% inflation is not the end of the world. The long-term average, as I pointed out here, is 3.8%. I don't think we're going to get that high, but that's not out of the realm of possibility. So if inflation stays in that 2 to 3% range, I don't think it has a big impact on the markets. If we get above long-term trend, if 3.5, 4, and it becomes an issue where the Fed's behind the curve and not ahead of it, then I think it might be a bigger issue in the markets. But as of now, I don't think it's a major concern. And I'm kind of in the camp that I think it's probably transitory, meaning we're gonna have a few months here where you'll see really big headline numbers, and then it'll start to wane. I mean, a lot of these are just year-over-year comparisons to last year in March and April, where a lot of things drop pretty quickly. So I think we'll get through that transition, and it won't be as big of an issue going forward.
John, if we do have significantly higher inflation, will this cause you to invest differently?
Yeah, I would think so. I mean, as it relates now, we're overweight equities. We would argue that we're underweight. If you're overweight something, you got to be underweight something. So we're underweight fixed income. I think at least over the last 12 months, that's been a good place to be. I think if inflation gets higher, which means rates will most likely be higher as well, it's hard to invest in a 10-year treasury at less than 1%, like we saw a few months ago. If they're higher, we might, and the real rates are better, we might consider changing that philosophy. So I think, if inflation gets higher, there's a lot of things out there that are hedges to inflation, but honestly, equities over the long run is probably one of the best hedges to inflation. So I don't think we would, move that far from equity positions, but I think we would definitely consider rejigging our allocations going forward.
Okay, so are you saying you wouldn't consider buying gold, for example?
I'm not a big fan of gold for a lot of reasons. I think if clients want to buy gold or they feel gold's a great hedge of inflation, we can work with them to do that. I don't think we'd be adding it to, Deb, to answer your question specifically, I don't know if we most likely wouldn't be adding it to portfolios. It's an interesting question. If you look over the last 3 or 4 months, gold has been going down, and the threat of inflation and/or interest rates have been going up. So it doesn't always hold the right. It's not always highly correlated, I guess I should say. But I guess the easiest answer is no. I don't anticipate us adding gold to the portfolios. If clients wanted to add gold to their accounts, and we have some that have, we can easily help them and work with them to do that.
Okay. Thank you.
So let's move into the markets. Move into the markets here. So I already talked a little about April, and we're off to a pretty good start so far in April. And so if you go back to, we use a service called Ned Davis Research, which does a lot of historical studies. April is the best month for equities. People probably think it's December or January, but if you go back to 1982, April is the best month. So we think, we're going to see that. Well, we already have seen it play out so far in the first half of the month. If you look at the seasonals there on the chart, the second quarter, which we just entered a few weeks ago, tends to be the best, tends to be one of the better quarters outside the fourth quarter. So we think there's some more seasonal strength going in the next few weeks. There is the old saying that, you sell in May, and most of those returns in the second quarter, which we're seeing currently, tend to be front loaded in April, and it tends to wane in May and June. So we'll see how this year plays out. We don't put a ton of emphasis on the seasonals because they do change from year to year, but a longer term picture, this goes back to 1928, second quarter tends to be pretty good. So, again, we're starting to think about, we will see corrections along the way. We acknowledge that. And I think at some point in time, we'll see some type of a consolidation or correction this year. And as we get into the summer months, that's probably going to, probabilities will probably rise. I mentioned valuations a little bit earlier. So this is a chart of the forward price to earnings ratio. So if you take the price divided by the S&P divided by what's the next 12 months of earnings, at least what the forecast would be, we're about 21, we'll just call it 22 times earnings, a little under 22 times earnings. We kind of think that's going to continue to come down. I don't know if it gets all the way to 20 before the end of the year, but somewhere around 20, the 20 range. And that's okay, I think, in the context of where we're at today, because I think we're going to see earnings pick up, and we have seen that. In fact, today is the unofficial start of earnings season. Both JP Morgan and Goldman Sachs came out with earnings this morning, both very strong. They're both financials, but they both had very strong earnings. So I think we're going to see guidance go higher, not lower, over the next few months and into next year for the 2022 earnings. So we're okay. We're comfortable with that, where the valuations are today, I think. But most market gain going forward will be earnings, or be driven by earnings, not multiple expansion. In fact, our thought is we'll probably see some contraction as we go forward. But earnings have been robust. I think that's further evidence that we're entering that reopening phase. The high water mark, this is basically the 12-month forward earnings forecast, and the high water mark was somewhere around just under 180 last year, and then we had the big decline, shutdown, recession, call it what you want. Earnings dropped pretty quick, and now we've seen this steady climb back up, and we're pretty much back above the high water mark. And our thought is we're going to see this continue to climb as we get to the end of the year. That's going to be closer to $200 forecast for 2022. My guess it would be above $200, but I think we need to get there before we go further. So earnings look good. Earnings are a function of the economy. As the economy looks good, earnings also look good. One of the things about the near term, and I mentioned earlier about, we probably will see some consolidation or corrections along the way. We have about 96% of the S&P 500 stocks, so call it over 450 of them, maybe 475 of them, are already above their 200-day moving average. And the 200-day moving average is a long-term trend line. It tends to show strength in the markets, and we're there now. In fact, we're probably at what they would consider an overbought area, but it tends to be long-term a good signal, because you might have some consolidation in the short term, but long term it tends to be positive for the markets, because it shows a lot of market breadth. So if in fact we do see some type of correction, we'd be buying the dip going forward on that. So not something to be too concerned about. In fact, anything, you probably want to welcome it and then be able to buy the dips going forward. Same with volatility. We're probably likely going to see volatility go up. Will be the exact opposite of what I just said. So we'll see volatility go up over the next few months. It's been coming down. I think it's at a 1-year low, if I'm not mistaken. But it does, I think it's probably going to head. We start to see volatility pick up as we get into the summer months. We're going to shift the focus on the budget deficits, the budget for next year, and infrastructure spending, taxes. How do we pay for these things? There's a lot of things out there. Geopolitical issues have not really been raised yet under the new administration. I know they're going to be engaging China pretty soon. How they're going to deal with the China trade policies they inherited from the previous administration. So there's a lot going on over the summer, and I think that'll add some volatility, but it's not something I'm concerned about at this point. Sorry. So finally, what we're doing here, we're basically entering a second year of a bull market. As we mentioned, that March 23rd date's important from last year. That was the beginning of the bull market, end of the bear market, beginning of the bull market. We saw a 75% move off the low there for the first year. Second year on average, if you go back and look at returns, always tend to be positive for bull markets. If you go back to 1957 and then forward, second years tend to be positive. They're up about 12% on average, anywhere from the low is 2% to the high, which is almost 30%. So we're already up 10% this year, although we're only, I think, up 5 or 6% from the March 23rd anniversary date. So again, I think that's another indication that we should see some positive momentum going forward over the next few months into the end of the year for sure. I'm going to grab a drink here, Debbie, but if you have any questions before we move on, I can take them now.
Of course I do. Can we talk back to the valuations? Valuations
Sure.
are high, and it's expected to see multiples contract back to 20% earnings. How is this good for investors in stocks and bonds?
Yeah, so as I kind of laid out with the stocks, there's kind of two things that drive returns or stock returns. One is, if you look at the PEs, one is the multiple, which, we've on record now thinking they'll probably start to contract. It's already contracted a little bit over the last few months, and 20 times just seems like a nice round number. I don't know if we get it 20 times or not, but somewhere around that area, which is another 1 or 2 turns down lower. But I think the other thing is earnings. So as long as earnings continue to rise, and I showed the projections for forward earnings, I don't think it's a negative for the stock market or equities in general. I think earnings will drive returns going forward, and as long as earnings continue to grow, I think we'll be okay. Bonds, that's a tougher call to make. I don't know if there's a direct correlation between equity multiples, other than multiples tend to go down when rates go up. And again, we've seen rates go up over the last few months, and multiples have come down. So, if that correlation holds and rates continue to go up, it's just going to be another tough environment for bond investing. And that's why we've been, slightly overweight bonds and slightly overweight equities and slightly underweight bonds over the last few years. And for the most part, that's worked out. And I just think going forward, as the economy heats up, it definitely is showing signs of heating up, and we enter this reopening phase. And I've heard people compare it to the Roaring '20s. I wasn't around in the Roaring '20s, so I can't say for sure. But if we have an economic prosperity like we did then I think you're going to see the economy continue to move, and I wouldn't doubt if rates start to continue to move higher. So I think it's just going to be a tough environment for bonds going forward. I think you can make a positive return, but I think it's going to be mostly driven by coupon and not much else. So.
Okay, thank you.
All right, so let's drill down a little bit into our portfolios. There's been a theme off the March low of last year, and again, I think heading into the second part of 2021 is we still think cyclicals are we're still overweight cyclicals versus defensives, and I think we're going to continue to do that. Cyclicals tend to be that area of that area or sectors of the economy that do well when the economy is expanding. So as you can see here, this is our large cap portfolio, which we use in client accounts. Materials, consumer discretionary, industrials, and to a lesser extent, information technology are all cyclical sectors, and we've been overweight those. This is our overweight positions here versus the benchmark, which would be the S&P. And then, two of our bottom three, staples and utilities, are defensive names. Real estate is a defensive name as well, and we're slightly underweight that one. The one that's kind of an outlier here is energy. And energy actually was the worst performing sector in 2020, and it's the best performing sector in 2021. It's probably a lot going into that. One of it is probably just a function of the economic growth. But an interesting thing about energy, it was up 30% in the first quarter, and 7 times there's been a sector that was up 30% at the beginning of the year, and all 7 times it was positive the last 3 quarters. So there's probably some momentum behind energy. We still remain underweight energy. I think there's a lot of secular issues there as far as the direction of people and how they move about and use alternative sources of energy. But that being said, it's something we're keeping an eye on, and I wouldn't be surprised if we add slightly to our energy positions going forward. So we talked about small caps earlier. Small cap leadership, as I already mentioned this, so I kind of already talked about this, but small cap leadership tends to wane in the second year of a bull market. Doesn't mean they won't be positive, have a positive return. They just don't tend to be leadership. And right on cue, that's been happening. So here's small caps outperformance of large caps, coming off that March low bottom, which is right about here. And you can see that. And then we've had a little bit of a rolling over here. I don't know if that's, these things very rarely end in a V or an upside down V, I guess, here in this case. So there might be some back and filling here, but on a relative basis, large caps, I'm not so sure they'll be market leaders going forward, but I still think they'll do fine. And like I mentioned earlier, we actually took the opportunity at the beginning of the year, after the big run up last year, to trim some of our mid and small cap positions, not drastically, but just take some of the gains we've seen over the last 12 months. The one we may have gotten wrong here, and it looks like we've gotten wrong so far, is emerging markets. The thought was we'd have a weaker dollar, and with a weaker dollar, emerging markets would benefit, and they would be, as well would any international equity, but they would benefit, and you'd see a big move off the bottom. They actually broke out of their trading range over the last 13 years. So we saw a little bit of that coming off the bottom, but we've seen a pretty big rollover here. Most of that is due to again, so far this year, the dollar has been strengthening, getting stronger versus other currencies, and the expectations going in this year would be that we'd be getting weaker versus other currencies. So it's a lot left in the year, and we'll see. There could be some choppiness there. So I'm not throwing in the towel on that one yet, but so far it doesn't look like it's going to play out like we thought it would. Real quick, another great example is home builders. Home building stocks have broken out 16-year period, finally above where they were 16 years ago. It's a great, as I mentioned earlier, great indicator of economic growth out there. I think home builders are probably just beginning to break out, and we actually own a home builder in our portfolios. So that's kind of the markets and the portfolios. I'll pause here, and Deb, if you have any questions, we can take them. What I want to talk about next is where we see things going forward. And again, I think there's this shift from a recovery to a reopening, and just talk briefly on some of the things we're looking at. So I'll pause there. If there's anything you have, if anything's come in yet?
Well, actually, yes. Are you considering Bitcoin or other cryptocurrencies?
So that's a great question. I was actually just talking about that this morning with one of our colleagues. So, as of now, our policy, and it's a corporate policy, is we don't buy Bitcoin or any cryptocurrencies for clients without getting compliance approval. I think, like a lot of people, we're still trying to learn more about the space and how it works. Coinbase, which is one of the biggest, I'll call it custodian. I'm not sure if that's exactly what they are, but they're an electronic wallet. You can buy and sell pretty much any of the major cryptocurrencies on it just went public. I think it was going public today, if I'm not mistaken. So I think there's a lot of moving parts right now, and we're going to see a lot of changes throughout the year. I know some of the big institutions, foundations, endowments, the Yales, the Harvards of the world are getting more and more into the crypto space and or actually the blockchain space. So it's something we're keeping a close eye on. I don't think it's going to go away. I don't think it's a phase where it's going to pass and move on. Government hasn't regulated it yet, and there's always the concern that they will if they can. I'm not even sure they could, but it's something we're keeping an eye on. I think the next big step out there is they're going to approve, the SEC will approve one of these exchange traded funds or ETFs that hold Bitcoin, which will make it much easier for the average retail investor to buy. You don't worry about your electronic wallet. You don't have to worry about your password being stolen, any of those things. So it does really bring it to the masses. And I know Fidelity and a few others are working on those. So I think that's probably the next big change we'll see in that area. I wouldn't rule it out that it's something we'll be able to provide access to clients. Kind of going back to your gold story, I don't think it's something we put into our portfolios anytime soon. Maybe some of the picks and shovels, so to speak, the companies that work in space, that might be something we look at. But it's a great question. I don't have a great answer for you. I think it's something we're trying to learn more about, like everybody else is, and as we move forward, we'll keep people informed. But as of today, it's not something we're interested in adding. I just think there's too many hurdles at this point.
As Bitcoin and the other cryptocurrencies gain more popularity, do you think they'll eventually have an impact on the US dollar?
Yeah, that's a possibility, and I think that's where the government regulation gets in. I think we're a long way from this, but if at some point in the future, and I don't know how far in the future, if somehow a cryptocurrency becomes the default global currency, taking over the dollar, that would be a major thing. Now, I think that's, if at all ever possible, it's a long way away, but I think that's what a lot of the central banks, the ECB, the Fed, would be concerned that it would have an impact on the dollar and kind of disrupt the financial markets. But I don't think it has a big effect at this point. But I think if it becomes more globally acceptable as a currency and not an investment, then I think it might. I think right now it's just more of a speculative investment. I don't think people really are. I know there's some things you can buy in Bitcoin, but I don't think people are holding Bitcoin, as I would hold $20 in my pocket. I think if we get to that point, then it's a different story. But I don't think we're there yet. I think we're still in the speculative phase. But I think that's the long-term goal. If we ever get there's another thing. And me personally, I kind of think if we get close to that point, or it seems like we're getting to that point, I think you'll see the government step in and regulate it, and then that's going to change the game. But that could be years down the road. So.
Sure. As long as before we move off of portfolios, are you concerned with the Biden tax proposal and how it might affect the portfolios?
Tell you what, I got a slide on that one, so I'll hold that question till I get to it.
Okay. Can I put a little plug in?
Yeah, go ahead.
For people that are interested to see our take on what the proposed Biden tax changes will be, Tom Seifert did a really nice webinar on it, and you can view it at www.fairportwealth.com.
Yep. Tom did a great job. So he's our content expert on taxes. So, all right, so let's jump into it. So, what are we looking at going forward here? I think, I've talked about the economy, so I don't want to beat a dead horse here, but consumer net worth tends to lead the economy. Consumers are getting stimulus checks. Their 401ks are going up. As I mentioned earlier, houses are selling at above asking prices. So consumers are in a pretty good spot right now. As you can see here, this is first quarter consumer net worth, and it's driving to a new high. It's at a trend over the last few quarters that's much higher than the previous trend. So I think the economy remains strong. I think it will remain strong over the next, at least over the next year, maybe wane a little bit as we go forward, but I think it's going to be above trend for a while. That tends to drive earnings, drives consumer spending. So I just think, you know, for us, this is one of the best way to look at the economy. It's a good way. It's a great leading indicator. So something we're keeping a close eye on. I did mention earlier about a little bit about politics. So, you know, people love free money. This goes back to when they were going to put the stimulus bill through, which obviously they did, I guess a few weeks ago now. Probably was early March, I believe it was, so about a month ago. You know, if you look at some of these, only 17% of voters opposed the stimulus package. I thought, interesting enough, you know, only 30% of Republicans opposed it, and which means 70% were in favor of it. And you know, people like getting stimulus checks, so we just got a third one coming out. I think it's hitting people's accounts either end of March into April, so they're seeing it now. Talking about Bitcoin, I know some people that are getting checks who were never out of work, and they're using the money to buy Bitcoin. So you can almost argue that the government's help stimulate the trade in the cryptocurrencies. So something we're keeping a close eye on. I think there's another one coming up here, that the child tax credit will be paid out monthly. So, you know, a lot of people will be getting another stimulus check over the course of a year on a monthly basis. So, you know, moving closer and closer to what was talked about as universal income. And I think, you know, we're going to continue to see that. So people do like free money. So if you're planning on going anywhere for Thanksgiving, you probably should book your flight now. This is actually an old chart. This only goes back to the end of March, and these numbers have moved up quite a bit in the last 2 weeks. But you know, the blue line is the TSA travel throughput, which means how many people are going through TSA. That's actually moved up quite a bit. And then the other one is open table, which people making reservations. I actually talked to a airline analyst who covers the airlines, and he was the one that said, you know, if you plan on traveling and during Thanksgiving, you should book your flight now, because he thinks there's going to be a scarcity of seats as we get into this reopening process. So keep an eye on it. And then, you know, as I talked about the recovery to the reopening, the key to all that is people get vaccinated. I was talking to Deborah earlier this morning. I got mine on Monday, my second shot on Monday. I know she's gotten hers. My wife has hers. My kids are getting theirs. So I think that's the key to everything. If you look at how it's going, I think it's going, you know, as well, I'll say it's going better than expected. In fact, I think it's going as well as can be. I know the J&J got shelved over yesterday, but I think that's a blip in the process. So the 7-day moving average, which is this dark, I guess, black line, we're now at 3 million shots a day, vaccinations a day. This is through, I think, April 9th, and on that day we did 4.5. But the average I just saw actually moved up to 3.2 million a day, which is the 7-day average. So it's been very successful. Been a few bumps in the road. I would not expect, I would be shocked if we didn't see some more bumps along the way. But I think, you know, the faster we get the vaccinations out there, and we're definitely doing it faster than we anticipated, the quicker we're going to see us move into the reopening phase, which is, you know, concerts and football games and all those other things that we haven't been able to go to. So Deb, you asked about corporate taxes, or you asked about taxes in general. I'll stick to the corporate side of things. Like you said, if they want to talk about the personal side, I think Tom did a great job on the webinar he did. But on the corporate side, there's a lot of talk about the rates going up from what is 21% from the Trump tax cuts passed, I think in 2017, to moving that up to 28 was President Biden's projection. I know there's been some talk, and there's probably not enough votes to get to 28, but 25 is probably not a bad spot in the middle that they could meet as a consensus or a compromise. So I think that's going to have an effect. This is something that we saw from Strategas Research, which is a group out of New York, and you know they see 2022 estimates right now growing about 15%. If you put in the tax cuts assuming they get passed. They probably won't get passed till 2022, so 2021 is probably safe. I doubt they'll do it retroactively, and that could drop to 8.7. I'm sorry, 8.5, about 7% decline, give or take. So it will have effect. I don't know if that's effect going from $220 to $205 or somewhere around there, but we'll see. It's something, again, we keep a close eye on, but until really numbers get settled on, it's hard to make any projections. So, you know, like most legislative process, it's going to take a while. I'm sure the numbers will move quite a bit, and when they get the infrastructure bill and the budget through, we'll have a better view of that. So that's one of the negatives we're looking at. The other negatives would be the budget deficits in general. I would say they're out of control. The red lines over here are this year's and then projected over the next 2 years. I'm going to make a prediction. I think these two will be higher than they are projected. That's been the trend over the last year or two. And, you know, we're going to set a budget deficit here that doesn't get rivaled until you go back to the Second World War. So we'll see how it plays out. But, you know, does it really matter is the question I ask. And I hate to say it, but I don't know if it really matters right now in the short term. You know, if you listen to the textbooks, they tell you all the deficit spending leads to inflation. That really hasn't been the case over the last 10 to 12 years since the financial crisis, but it's definitely a concern, and it's something we're keeping a pretty close eye on. And then the last one would be just the expectations for higher inflation. This this dark line here is the yield curve. You know, we had to flatten back in, I think it was late 2019, early 2020, but it's been moving up higher. And, you know, that tends to be a good thing, but, you know, as the yield curve moves higher, you know, you tend to have expectations for inflation moving higher too. So we're keeping an eye on that. We talked a little bit about before. I think we're going to see some the inflation numbers move up here over the next couple of months. I hope it's transitory. I think that's kind of the Fed's view as of now, but something we're going to keep an eye on. But you know, so budget deficits, the inflation going higher are, you know, are concerns. And then, as I mentioned earlier, any corporate tax changes out there. And again, most of those things are probably a little too early to hammer out at this point, but it's something we're keeping a close eye on. And then finally, you know, so again, if there's been a theme to this today, it's been, you know, moving from that recovery to reopening. And what does that really look like? This is a couple bullet points that Evercore put out, and, you know, I don't disagree with it. I think it's pretty close, or as close as anybody can get. You know, I call it the triple threes, I guess. So you can see unemployment easily declined to 3%. You know, we're at 6% today. Here in Strongsville, Ohio, I can't speak for everybody. I don't walk into any type of business that they don't have a sign on the door that says they're hiring. So I think we'll continue to see the unemployment rate decline, especially if we get the restaurants back open to maybe not full capacity, but a larger capacity than they're at today. Inflation can move to 3%. We talked a little bit about the long-term trend of 3.8% is the 50-year number. I don't think inflation between 2 and 3 is a big issue for the markets, but, you know, I guess we won't know until we get there. And then bond yields can move up to 3%. That one's probably a little tougher, but again, I think if the economy continues to do well, you can see bond yields move up as well. So I don't think any, as they mentioned here, I don't think any of those really are a big hit to the scenario that I've laid out before, which is the economy improves, earnings improve, and the markets improve. And the markets tend to stop going up when earnings stop rising. And so far, earnings expectations continue to rise. So I think we're in a pretty good position. I think we're going to see some declines or corrections along the way. That's natural. I wouldn't be surprised if we're probably overdue for one. You know, again, I think our view is those are opportunities to reestablish portfolios or reallocate them, and we'd probably more likely to be buying those dips than anything else. So last slide, you know, if there's a lesson from 2020, I'd probably use this. I'm going to use this a few times over the year, is just to stay invested. So, you know, again, if you look at this chart from JP Morgan, you know, a 50-50 portfolio, if you have over a rolling 5-year return, has never had a negative return. 10-year rolling portfolio never had a negative return, nor has a 20-year. So I think you want to stay invested, take the opportunity to rebalance when you can. Obviously, always review your asset allocation and your risk tolerances and where you are, with your own life cycle. But overall, we still think the markets have some upside here. I think it's going to be driven by earnings, and earnings will be driven by the economy. So as long as the reopening continues, I think we have as I always like to say, a tailwind or the wind behind us, if you want. So I'll leave it there, Deb. I don't know if there's any other questions you have, or if you have any closing thoughts, we can go from there.
I'd like to see yields at 3% on bonds.
Yeah.
I think everybody would be happy with that. We really don't have any other questions right now, but for those people who didn't type anything into chat and they might have questions, why don't you shoot them to your advisor or directly to the investment team, and we'll be happy to answer them. But in closing, I want to say that we really appreciate you joining us today. It's our privilege to inspire you and your family. And we feel sincere gratitude for your loyalty. This is something that you can't manufacture. It just comes from the heart. Stay safe and well until next time. Thank you all.
Bye-bye.
Bye-bye.